Let me tell you one simple truth. Everybody in this world wants freedom, but most people spend their life chasing numbers that were never in their control. There is something more important you need to know about money. As time passes, money slowly loses its value due to something called inflation. Inflation means prices go up over time, which causes your money to lose some of its value. For example, 10 years ago, a cup of coffee might have cost $2. Today, the same coffee costs $5. The coffee didn't really change, but the value of money did. Now, the problem is that many people still think keeping their money in the bank is the safe and secure way, and that is counted as investment, while being completely unaware of the consequences of inflation. Now let's put this into perspective. Imagine you put $100,000 in the bank. The bank gives you 2% interest. So after 1 year, you have $102,000. But the average inflation rate is 3%. The prices of goods and services have gone up by the same amount. Now, even though your account now shows $102,000, it can only buy what $99,000 could buy you a year ago. So that means keeping all your money in the bank isn't the safest option. That's where the idea of investing comes in. Investing simply means putting your money into something you believe will grow in value over time. It could be company, property or collectibles. You are basically letting your money work for you instead of working for money. There are a lot of ways to invest: stock, bonds, real estate, cryptos, EFTs and more. But in the investing world, the most popular term among them is stock and stock market. So what exactly is a stock? Simply put, a stock represents ownership in a company. When you buy a stock, you actually own a small part of that business. Think of it like this. Imagine the whole company as one big circle. The circle is divided into 10 smaller pieces. Each piece is called a share. If the founder owns 6 pieces, means they own 60% of the company. The people who own the remaining 4 pieces, the rest of the 40% of the circle, are called shareholders. Now you might be wondering, why do companies sell stock or shares? And the company do so mainly to raise money. Running and growing a business costs a lot. Companies may need fund to build new factories, develop product or expand into new market, or even cover day-to-day expenses. And the reason they sell stock is to share risks. By selling ownership in the company, founders and early investors can spread the financial risks with public investors instead of relying only on the bank loans or their own money. Now for this, the trading of stock happens in a place called stock exchange. Think of a stock exchange as a marketplace where people buy and sell shares of different companies. Some of the most well-known stock exchanges include Euronext, the New York Stock Exchange, Nasdaq, and there are many more depending on your location. But don't get confused. You don't buy shares directly from the stock exchange itself. To invest, you use a stockbroker or brokerage app which buys and sells stock on your behalf. This broker acts as a middleman between you and the stock exchange. Now, when companies issue stock, they generally come into two main types: common stock and preferred stock. First, let's talk about common stock. Common stock is what most people think of when they hear the word stock. When a common stock gives you voting right, meaning you can participate in important company decisions such as changes in the company policies and electing the board of directors. Typically, each shares equal one vote. If you won 1 shares, you get 1 vote, and if you won 1000 shares, you get 1000 vote. But the main advantage of common stock is its growth potential. If the company performs well, the value of your shares can increase significantly, often more than preferred stock. However, with higher potential return comes higher risks. If the company goes bankrupt, common stockholders are last in the line to receive any remaining fund, and in many cases, they may receive nothing at all. Preferred stock. Preferred stock, on the other hand, is more stable and predictable. Preferred shareholders don't have voting right, but they receive other benefit in return. The biggest advantage is priority dividend. Preferred shareholders are paid dividend before common stockholders, and these payments are often fixed and consistent. This makes preferred stock more attractive to investors who want steady income rather than high growth. And even in the event of bankruptcy, preferred shareholders are paid before common shareholders, though still after creditors. So which is better? That just depends on your goals. If you want a higher potential return and can tolerate more risks, common stock might be a better fit for you. But if you prefer stable income and lower volatility, preferred stock might suit you better. Once you understand this basic, the final two concepts you need to complete your stock market foundation are index fund and ETF. So what is index fund? An index fund is type of investment that track a group of companies. For example, the top 500 companies in the US stock market, known as the S&P 500. When you invest in an index fund, your money is automatically spread across all the companies in that index. This is called diversification, and it helps to reduce risks. If the company performs poorly, its loss is often balanced by the performance of other companies in the group. Because of this, index funds are generally more stable and lower risk than investing in a single stock, whereas ETF, exchange traded funds, is essentially a basket of investment. Inside this basket, you might find technology companies, bank, gold, bond, etc. If you are not familiar with bond, a bond is basically a type of loan you give to government, company or organization, and in return they pay you interest and return your money after a certain period of time. Now you might be thinking, why should you invest? And the answer is pretty simple: growth potential. While a bank might just offer 2 to 4% interest rate per year, the investing world has historically returned 7 to 10% interest a year over the long run. Of course, it comes with the risks. The market rises and falls like a roller coaster, but over time, it's been one of the most powerful ways to build the wealth. Just look at people like Warren Buffett, Carl Icahn or Joe Soros. They understood the risks, accepted the challenges, and had a long-term vision, which allowed them to grow their wealth and achieve extraordinary success. Now, even though investment market can provide great returns, they shouldn't be seen as a way to make a lot of money very fast. Investing is truly a long-term game, so the focus will always be on building a strong and well-diversified portfolio. You may hear the term like buy the dip or encounter promises that sound too good to be true, often linked to Ponzi scheme. So it's important to stay cautious and do some research before making decision. Only invest your money what you can afford to lose, and don't panic and sell when your shares temporarily lose value. Because in the end, investing comes down to patience, discipline, and staying committed for the long run.